Thinking you are early simply because you found a small market cap is the ultimate amateur mistake in 2026. True asymmetrical edge, the kind that defines generational wealth cycles, is not about finding tiny valuations. Being early is discovering a massive, world-altering trend before the crowd and selecting the explicit infrastructure assets built to absorb that trend's structural capital. Today, we deliver a masterclass dismantling the low-cap illusion. We unpack why tokenomics have permanently broken the traditional small-cap meta, map out the 5 macro-thematic trends dominating the remainder of 2026, and conduct an asset-by-asset analysis of the infrastructure engines from ONDO to TAO and hyperliquid, designed to turn systemic trends into undeniable revenue generation. Welcome back to the Signal and Noise podcast. My name is Newell. Take a moment to subscribe. Let's dive in. Let's start by performing a hard quantitative autopsy on the concept of market cap in the modern digital economy. In the early eras of digital assets, think 2017 or even parts of 2021, you could occasionally find an obscure asset with a small circulating supply. Purchase it on an ungated decentralized exchange and watch retail momentum lift it purely on supply scarcity. But in 2026, the structural plumbing has completely evolved. The fully diluted valuation, FDV, trap. The vast majority of low market cap tokens launched today are an illusion engineered by late-stage venture capital. A project debuts with a low market cap of $20 million, but carries a staggering fully diluted valuation of $4 billion because only 1% of the supply is circulating. Retail buyers see a small cap. Sophisticated market makers see an incoming multi-year wall of structural programmatic distribution, the infinite fragment matrix. Because deployer tools and layer 2 solutions have reduced the cost of launching a token to effectively zero, there are now millions of competing low-cap assets. Liquid capital is hyper-fragmented. The probability of an unbacked low-cap asset naturally gaining sustainable structural liquidity without an explicit systemic trend to feed it is statistically approaching zero. The paradigm shift. Elite traders do not screen for low valuations. They screen for macro-thematic trends that are completely decoupled from localized speculation. They look for structural trends that legacy institutions, sovereign states, and automated machine networks are legally or economically forced to capitulate into. When you find a massive trend early, it doesn't matter if the asset's market cap is $500 million or $5 billion. The sheer volume of incoming capital will treat that valuation like absolute water, expanding its surface area at a velocity that makes small-cap speculation look like a statistical error. Let's pivot directly to the trend matrix and analyze the specific high-visibility assets built to capture these massive structural shifts in 2026. First, let's look at the absolute gold standard of the current cycle, the tokenization of real-world assets, RWAs. For years, tokenization was a theoretical concept. In 2026, it is a hard regulatory reality. BlackRock and Franklin Templeton are systematically moving money. The asset anchor, Ondo Finance, $ONDO. As the market navigates a corrective phase, Ondo trades right near the $0.36 to $0.41 range. Retail spectators are arguing over chart patterns. Meanwhile, institutional desks are tracking Ondo's unique integration depth connecting U.S. treasuries to on-chain liquidity. You aren't buying a small-cap token. You are front-running the migration of global institutional money markets into the digital ecosystem. Second, let's talk about the single most aggressive capital absorber in the world, decentralized artificial intelligence and compute allocation. The centralized tech monopolies are facing severe physical constraints, silicon shortages, energy infrastructure bottlenecks, and data monopolies. AI labs require borderless, permissionless computation and verified data layers to scale their autonomous models. The asset anchor, Bitensor, TAO, staring at Bitensor holding its core technical support matrix right around the $253 level. The signal is that Bitensor acts as the universal neural network substrate, allowing machine intelligence to be globally traded across subnets. At $253, the asset represents a premier infrastructure play on the machine-to-machine economy, capturing the AI revolution. This brings us to our third core macroeconomic trend, the permanent migration to on-chain execution and high-velocity trading platforms. Historical narrative assumed decentralized trading would stay clunky, but user behavior in 2026 has completely shattered that assumption. Regulatory pressures and counterparty risk have driven traders to demand high-performance, self-custodial infrastructure. They want low latency and fee alignment. The asset anchor, hyperliquid, $HYPE. Look at the sheer performance profile. The $HYPE token recently surged over 11% to hit an all-time record high of $76.90. While analysts warn about unlocks, the structural reality is that Hyperliquid's dedicated Layer 1 app chain is systematically eating the volume of legacy exchanges, driven by interest in major 2026 events like synthetic pre-IPO stock futures tracking the historic $2 trillion SpaceX Nasdaq listing. When an asset like $HYPE recaptures its transaction fees and funnels that yield back to its active community, it becomes a core infrastructure utility. Finally, let's round out our trend matrix by looking at the two critical retail and consumer-facing frontiers: mass infrastructure abstraction and global payment rails. First, the mass adoption engine. The winning trend is chain abstraction, the total disappearance of the blockchain architecture beneath the user interface. The asset anchor, Near Protocol, $Near. Staring at Near Protocol trading comfortably inside its local support band around $2.28 to $2.49. Near has quietly scaled to process millions of active daily user wallets via decentralized data availability and seamless account abstraction. It handles consumer scaling efficiently. Second, the sovereign borderless payment migration. Legacy banking corridors like Western Union remain incredibly slow and fundamentally broken. The asset anchor, Telcoin, $TEL. Trading at nominal sub-cent levels under $0.01, retail spectators constantly make the mistake of classifying Telcoin as a cheap meme asset. But the underlying trend is institutional. Telcoin has spent years quietly embedding its software stack into the global telecommunications infrastructure. Let's bring it all home to the definitive structural verdict: stop trading microcap illusions. Stop letting predatory VC unlocks dictate your strategy. The 2026 supercycle looks for massive trends: tokenization, AI, on-chain venues, chain abstraction, and mobile remittance. Position your capital into primary infrastructure engines. Track the trends, decode the plumbing, stay sharp, stay focused. We'll see you on the next block. My name is Newell. Do like and subscribe.